Hey there, this is Mike Kinnett from Prostatis. If you're new to the channel, welcome. We simplify retirement so you can keep more of what you've earned and protect the life you've worked so hard to build. Now, most people think capital gain taxes are something you deal with when you're working, when you're selling a stock, a business, or maybe even an investment property. But in retirement, capital gains can sneak up on you fast and hit you harder than you might even think. Let me walk you through why, and more importantly, what you can do about it. We've worked with thousands of retirees over the years who have said to us, I don't have earned income anymore, so I'm going to be in a lower tax bracket. Well, first and foremost, before we even get into the capital gains issues, why in the world do you think you're going to be in a lesser tax bracket? What exactly is going to leave your income needs? What expenses are going to go away? Yeah, maybe your house, but I would argue even if your mortgage payment goes away, between the honey-do list, the round to it list, and the bucket list, you're going to spend more money during retirement than you ever have in any time in your life. You're going to be so busy being retired, you're going to be shocked on how much money you're going to spend. And the fact is that nobody in their right mind chooses to have less income during retirement. That's not the way this works for most of us. And it certainly shouldn't be the way it works for you, or it shouldn't be the way that you want it to work for you. You want to have a lifestyle that's consistent with what you're doing now. You do not want to take a pay cut. Now, moving on to this capital gains issue. What people don't realize with these retirees who keep telling us they're going to not have earned income, what they don't realize is selling appreciated assets like mutual funds or rental properties or stocks. These things can trigger capital gains. And depending on your income, those gains can be taxed at 0%, which would be good, 15 or even 20%, plus net investment income tax if you're above certain income thresholds. So we had a couple come into our office, and it was an interesting story. And they were shocked. And when they came to us, we understood exactly what happened, but they were just blown out of the water. They did not understand why all of a sudden they were paying all this taxes. And here's their scenario. They were in the 12% tax bracket. They had a nice, comfortable income stream. Everything was where it needs to be. But they needed an extra $1,000, $1,000 extra in order to actually put a down payment on a vacation that they were going to be taking the next year. So they went to their advisor and they said to him, hey, we need an extra $1,000. And the advisor said, great. How much taxes do you want to have withheld? And now, first of all, my first reaction is how in the heck can this guy be a financial planner and advisor if he doesn't understand the tax implications? But ignoring that, they said, I don't know. And he said, well, go talk to your tax guy. Why should you have to go talk to your tax guy? But let's move past that. So they go talk to their CPA, and their CPA says, oh, $1,000, you're in the 12% tax bracket, have $120 taken out. Well, that makes perfect sense, right? Logically, 12% tax bracket, $1,000, take out $120. Here's where those not understanding how taxes come into play. This is why it's so important to work with a phase 2 fiduciary who understands the tax implications, because here's what happens. Yeah, they took the $1,000, advisor sent it to them just like they asked for. And it was $120. He had $120 taxes withheld. But when they came to talk to us and we're looking at it with them and explaining to them what exactly happened, the $1,000 that they took out, it forced more of their Social Security to be taxable. So instead of having zero Social Security taxable, all of a sudden $185 of it, $1,800 was taxable at the 12% tax bracket, right? So another $1,850 because they took $1,850 of Social Security now became taxable at 12%. And because the Social Security now became taxable, it forced their capital gains to now be taxable at 15%. So this $1,000 distribution, they wanted $1,000 to put a down payment. The $1,000 cost them almost $500 in taxes. That's the 50% tax bracket. That is insane. And that's why tax planning, understand how these things work, understanding how capital gains works, understanding how Social Security taxes work, having a fiduciary, a phase 2 fiduciary in your back pocket, explaining to these things all along the way. That's why it's so important to have that as you go through retirement. And to make matters worse, we see this every year. Capital gains are under political pressure. Now, depending on who's in office, we can see those rates go up or down, right? We saw Biden talk about raising them. We saw Trump about lowering them. They've talked about raising them for certain people above certain thresholds. Imagine being in a place where you don't have to worry about what they keep doing to you on tax rates. Working with somebody who truly understands the tax laws, we will always be able to figure out a way around the tax problem. Now, on the other hand, if tax cuts become law again, Retirees may want to hold off on realizing gains until the rates are more favorable. So timing does play a huge role in this, especially when you're planning for the sale of a large asset like a business right before you go into retirement. You have to have those conversations ahead of time to take advantage of the tax laws that are in place now. So part of the tax planning process, part of the whole financial planning process is that we have to have a conversation about your asset location. Not just where you want to invest, but how you want to invest. Not just what you invest in, but where are you investing in the most tax efficient manner possible. Holding growth oriented assets in tax advantage accounts and building strategic and being strategic about what you keep in brokerage accounts versus an IRA can make a huge difference over time. And if you're charitable minded, gifting appreciated assets instead of cash can help you avoid paying taxes on gains altogether. And that's just one of the several smart tax moves you can make that are often overlooked. And for business owners, the amount of tax planning you can do is exponentially even larger. And so many people come into our office that own businesses, have sold them, and their CPA literally told them to stroke a check rather than doing tax planning ahead of time. Imagine selling your $10 or $20 million business and paying zero taxes on the sale. We had a guy who sold his marina, $40 million sale, almost all of it was taxes, sold it, paid zero taxes. We only pay taxes when we actually use the money. It's called strategic tax planning. It's understanding not only what to invest in, but where to hold the assets when you make the sale. And it all happens because they worked with a phase 2 fiduciary who understands tax planning. And you need to understand taxes before you make final decisions, because the tax implications can be huge. It's the difference between paying zero taxes and paying upwards of 40% plus in taxes. Look, capital gain taxes don't impact just the ultra wealthy. If you've saved and invested well, you may be more exposed than you realize. But with proper planning, you can stay ahead of the curve and protect your income, your Medicare costs, and your long-term financial health. Do you want to see where you stand today and how your current retirement plan holds up to capital gain exposure? Well, download our free Savvy Investor Retirement Summary, or better yet, schedule a discovery call with our team today. And if this video helped you think differently about your current tax strategy, give it a like, subscribe to the channel, and drop your questions in the comment section. We are here to help you.